Well, the HR department tried to trick us into coming back to the office, and we saw right through their adolescent games, and we said absolutely not. And that means we're still here on our field trip. And last time we talked about commodities as an investable asset class. This time we're going to examine commodities ETFs. And Ryan Katz at USCF Investments is still with us. Ryan, welcome back.
Thanks.
So as we discussed before, people have traded commodities throughout history. Early civilizations traded livestock and the agricultural goods. In our era, commodities future trading has been used. But beyond that, I think the real breakthrough has been this revolution of this securitization of commodities via exchange-traded funds and ETPs and ETFs. Just talk about that development.
Sure. Well, the ETF industry has made it very easy for investors to build diversified portfolios efficiently. After the proliferation of equity ETFs, commodity ETPs joined the party, so to speak. First, in 2006, here at USCF, we launched the USO, the United States Oil Fund, which allowed investors price exposure to oil without opening a futures account for the first time. So it was widely adopted, and prior to an ETP like USO, you would open your own futures account, meet margin calls, have to roll positions yourself, and so on.
And sleep with one eye open.
Correct, absolutely. So it's just
or maybe two eyes.
So it made it just much easier for a regular retail investor to get in and out of oil, and then obviously other commodities as time has gone on as well.
So commodity ETPs will generally come in three types of packages, as you know. There's the grantor trust, there's the limited partnership, and there's the ETN, also known as exchange traded note. And before we discuss taxes, we need to mention that unlike other product structures, the ETNs do carry credit risk from the issuing financial institution, and that's important for people to understand.
Yeah, absolutely. It's something that I don't think a lot of investors consider, but you are opening yourself up to default risk of the issuing institution. Along with that, there's also issues in terms of the volume of those trading volume. So you may be subject to paying a premium to get in and out, and also some divergence from the index that they're tracking as well at times. So there's definitely some other implications to consider when looking at ETNs versus the other ETP structures.
If you're just joining us, we're pleased to be talking with Ryan Katz at USCF Investments. Be sure to go there, uscfinvestments.com, to learn more about investing in commodities. So when you're huddled with USCF's product development team and you're in the midst of a wonderful midnight brainstorm about the next great commodity ETP to launch and introduce, how much consideration do you give to the actual product structure, and which product structure gets matched up with the specific commodity or group of commodities that you're aiming to track? Talk about that.
No, absolutely. Well, that comes up very early on in the product development process. First, we're evaluating the strategy as to who's going to use it, first of all, and how it's going to be used, whether it's going to be a short-term tactical trade, long-term strategic allocation, the type of investor, and really the type of tax reporting that they would like. A good example of that to use would be USCI. We launched 2010, and then we didn't launch its sister fund until 2017, which, as we discussed, SDCI avoids the K1, kicks off the 1099, but very early in the product development process is where we're choosing a wrapper based on the end user and their preferences for how they like their tax reporting.
It's good too that you have both, one with the K1 and one without, because really the investor needs to pay attention. For example, if I've got a tax deferred retirement account where I don't have to worry about those annual 1099s or K1s, that type of product like USCI might be more suitable and ideal for a tax deferred account versus SDCI, which would be obviously more simplified in a taxable brokerage account.
Yeah, absolutely, and I think that some investors have had some headaches previously or ongoing with K1s, but it's also important to point out that the K1 can actually have tax benefits for the end investor depending on their income. Your higher income earners may find that the K1 product is a better fit for them for tax purposes, as you get 60/40 long-term, short-term capital gains treatment, no matter what your holding period is, as opposed to the 1099, which is taxed at an ordinary income rate.
Yeah. Let's talk about one last aspect of commodity ETPs. Previously mentioned SDCI and others like it hold commodities futures contracts. And these contracts are constantly expiring and being replaced. And that's not anything bizarre or alarming. It's completely normal. It's a routine part of how these products work. And it's an automatic feature. It's not something that investors need to do themselves. It's done for them. What are some things, though, that people need to keep in mind about the inner workings of commodity ETPs, and specifically as these commodities futures contracts are being replaced and expiring?
Absolutely. So you have to keep in mind that we're getting our price exposures through the futures market, and so we do need to roll our positions prior to expiration. Otherwise, as we discussed, you get physical delivery, which we don't want.
1,000 barrels of crude oil on the driveway is not going to work.
Not for most. But we need to roll our position prior to the expiration of those contracts, and so the dynamics of the futures curve are going to have an impact on your return. In a contango market, you probably hear these words occasionally, contango backwardation. In a contango market, you have to roll into a contract that is at a higher price than the current month's contract. So you get that negative roll yield. But alternatively, when you're investing in a backwardated market, you're rolling into a cheaper contract. So you actually have this positive roll yield. So that's really important when looking at, especially single commodities, is looking at the dynamics of the futures curve and maybe using more of a optimized approach to where your futures exposure is going to be. In a contango market, a 12-month oil strip like our USL is likely going to be better than our front month only futures contract that's catching the brunt of that contango negative roll yield. Alternatively, as well, in backwardated markets, you may want to be up at the front of the futures curve, so USO may be a better fit.
Very good. Well, Ryan, thank you very much for your insight. Be sure to visit USCFinvestments.com to learn more about investing in commodities. I'm Ron DeLegge at ETFguide. Be sure to follow us on Twitter, our handle @ETFguide, and subscribe to our YouTube channel.